Hey, tech enthusiasts and investors. As we approach the end of 2024, you might be wondering, will the stock market continue its festive rally, or will this year end with a thud? In this video, we'll explore why the usual holiday cheer for US stocks might be facing some unexpected headwinds. So, grab your eggnog and let's dive in. 2024 has been a stellar year for the S&P 500. Up more than 23%, this index has outperformed expectations and delivered incredible returns. But December, traditionally a month that delivers the Santa Claus Rally, has brought some unexpected volatility. Wall Street typically enjoys a strong close to the year, with the last 5 trading days of December and the first 2 of the following year historically yielding an average gain of 1.3%. This period has even earned the nickname Santa Claus Rally, a festive finish for investors. However, this December, we might be seeing less of Santa's cheer and more of Scrooge's caution. The S&P 500 took a big hit this week, suffering its largest one-day drop since August, as the Federal Reserve signaled fewer interest rate cuts than expected. But what's really happening under the surface of this market? Let's break it down. On the surface, the S&P 500 may look like it's in a good place, but dig a little deeper, and the cracks begin to show. Here's the worrying part. 8 out of the 11 S&P 500 sectors are in the red for December. When a broad market index like the S&P 500 sees sector-wide underperformance, that's a red flag for investors. But it doesn't stop there. The equal-weighted S&P 500, which tracks the performance of an average stock in the index, is down 7%. This tells us that the market's rally has been concentrated in a few select stocks, rather than being broad-based. And if that wasn't enough, Congress threw another curveball at the markets this week. On Thursday, lawmakers rejected a crucial package that could have prevented a partial government shutdown. A shutdown could disrupt essential services, adding even more uncertainty to the market's outlook. Anthony Saglambine, chief market strategist at Ameriprise Financial, put it bluntly. Investors are concerned about the possibility of a government shutdown, especially if it drags on into the new year. Now, let's talk about another factor weighing on investor sentiment: rising Treasury yields. On Thursday, 10-year Treasury yields hit 4.55%, their highest level in over 6 months. This spike is significant because higher yields put pressure on equity valuations, especially when the stock market is already trading at a premium. Right now, the S&P 500 is trading at 21.6 times forward earnings estimates, well above its historical average of 15.8. That means stocks are expensive, and with yields climbing, the market could face some tough decisions. Matt Maley, chief market strategist at Miller Tabak, believes that the market is now facing a hard reality. Stocks are pricey, and the Federal Reserve isn't likely to be as accommodating as it was in the past. Investors are realizing that the Fed's policies may not provide the support they hoped for. In other words, we're nearing the end of an era of ultra-low rates, and it's making stocks look less attractive. But it's not all doom and gloom. Chuck Carlson, CEO of Horizon Investment Services, believes that this week's pullback could actually be a good thing for the market in the long run. Why? Because it has eliminated some of the frothy sentiment that was driving up stock prices. In other words, the market may be resetting itself, getting rid of the excess optimism that often leads to a correction. If the market can hold steady and find support, there's a chance for a rebound in the new year. But if this downward trend continues, it could spell trouble for the broader market, particularly for those investors hoping for a smooth finish to 2024. So, what about the Santa Claus Rally? Well, this is an interesting period for investors. Historically, when the last 5 trading days of December and the first 2 of January are positive, the following year has seen gains more than 90% of the time. That's a pretty solid track record. But this year, it seems like the rally may have come early. The S&P 500 posted an impressive 5.7% return in November, fueled by the surprise of Donald Trump's presidential election victory. Some analysts, like Chuck Carlson, argue that this November surge was the real year-end rally, meaning December may not deliver as much of a boost. It's also worth noting that the market's rally has been increasingly narrow. While megacap stocks like Tesla, Alphabet, and Broadcom have performed exceptionally well, these gains are not necessarily reflected across the broader market. For example, Broadcom shares are up 35% in December after predicting huge demand for its custom artificial intelligence chips, which pushed its market value above $1 trillion. But such gains are rare, and many other S&P 500 stocks are struggling. In fact, the number of S&P 500 stocks declining has outpaced those advancing for 13 consecutive sessions as of Wednesday, the longest losing streak since 2012. And here's another key technical indicator. Only 56% of S&P 500 stocks are trading above their 200-day moving averages. That's a low for the year and suggests that the overall market momentum is weakening. Adam Turnquist, chief technical strategist for LPL Financial, advises caution. He recommends waiting for support levels to be established and for market momentum to improve before buying the dip. In other words, investors should be patient and watch for signals of recovery before jumping back in. So, what does all this mean for the future of the U.S. stock market? The U.S. is facing significant challenges. Rising yields, expensive valuations, and an uncertain political climate all point to a bumpy road ahead. On top of that, the market's strength is increasingly concentrated in a few megacap stocks, leaving many smaller companies behind. China's economic rise is also looming large. With the U.S. grappling with its own economic hurdles, China continues to make strides on the global stage, further complicating the situation. If the U.S. can't manage these headwinds, it could face even greater challenges in the coming year. But don't count the U.S. out just yet. Historically, when the final stretch of December and the first few days of January show positive results, the following year has often ended in the green. The question is, can the Santa Claus Rally still deliver, or are we witnessing a turning point for U.S. stocks? As always, time will tell. 2024 has been an exciting, unpredictable year for investors. And as we head into the final stretch, we'll be watching closely to see if the Santa Claus Rally makes an appearance or if we're in for a rocky finish. What do you think? Will the market bounce back, or are we in for a rough ride as we close out the year? Let us know your thoughts in the comments below. And if you enjoyed this video, don't forget to like, share, and subscribe for more updates on the world of finance and tech. Thanks for watching, and stay tuned for more insights on how the global market is shaping up.